Welcome to Finance 390. The first chapter is chapter 1. So in this particular chapter, we're going to talk about the goals and the functions of financial management, as you can see by the chapter heading, just to get an idea as to what finance is all about. Some of the learning objectives is we're going to talk about the disciplines, particularly accounting and economics, that are basics or building blocks for accounting, and economics are building blocks for finance. We're going to talk about kind of like what finance is and the fact that it's very much based on risk and return. And we're going to talk about the fact that it's the goal of the finance area and the goal of the company actually to maximize shareholder wealth, which, as you can see, is measured by share price. It's not the goal of the company to maximize profits, because profits does not factor in risk. So finance is very much based on economics and accounting. Economics in the sense of things like opportunity cost, accounting, cash flows. Although accounting is incomplete, it doesn't factor in risk. It does not factor in opportunity costs, which things like lost sales, the fact that you're in class right now and you're not earning a paycheck somewhere else, things along that line, which finance people do factor into their financial decisions. Risk. Risk is my second favorite four-letter word, because everything we do, crossing the street, taking this course, has a certain level of risk. And it's the trade-off between the risk and the return. So a low risk will typically get a low return. High risk will get a high return. And towards the end of the course, we'll actually do a calculation on the risk-return trade-off, so you can determine which option is the best based on increases in risk will increase your return, but is it worth it? By the way, my favorite four-letter word is cash, especially if it's followed by the word inflow. So, and we will be doing these activities. We will do capital budgeting later in the course. We'll talk about capital structure with weighted average cost of capital, working capital, which is really short-term financing. As mentioned earlier, it is the goal of the organization to maximize shareholder wealth. Shareholder wealth is measured by the share price. So shareholders will be very happy when the share prices increase. They'll be very unhappy when they go down. They do not look at the level of profitability. It is a factor, but if you increase your profitability, but you've increased your risk significantly, your share price will actually go down. So for example, if your profits go up 10%, but your risk goes up 20%, the value of the shares will actually decrease. And your shareholders will not be happy with you. So in this particular case, we also want to make sure that the goals of management and their compensation is targeted towards the same thing as what the shareholders want. So it's very common for senior executives to get stock options. The stock options only become valuable when the price of the share increases. So they have the same kind of goals. Otherwise, they might be flying around on a corporate jet because it's nicer than flying with, airlines, and having to go based on their schedule. So the agency theory has to do with the conflict between, basically, if you want to say selfishness or self-interest for managers, like doing what's right for them versus what is right for their shareholders. There was a famous case several years ago of a gentleman named Conrad Black. Conrad Black was a very powerful CEO, but what he did was he used corporate assets, corporate jet, trips and things like that for personal gain. And the shareholders got upset with this. And not only was he removed as CEO, it was so flagrant that it was actually considered to be a criminal act and he wound up going to jail. So because he used corporate assets for personal gain. So you don't want that. I've seen it many times in my career where managers do what's right for them as opposed to what's right for shareholders. And again, here just some more detail on it. Things like making sure these days companies need to be more sensitive to things like pollution, polluting the environment. Well, to clean that up costs money, or to not pollute the environment can also cost you money. But that is something that is socially responsible and is part of the triple bottom line, which is people, profits, and planet. A finance manager, what do? You do finance. You manage your cash. Most, if not all of you, could tell me exactly how much money is in your bank account right now. And if you can't, you just look it up with your online banking. You also pay attention to things like inventory. During the COVID crisis, there's a lot of joking around about, people hoarding certain particular products, but that also absorbed people's cash. So paying attention to how much food you have in your house. Every time you buy food, your cash goes down. The finance manager will occasionally deal with bonds. Some companies don't issue bonds ever. They will also deal with leases, especially of capital equipment, large pieces of equipment. They'll make decisions about issuing stocks or shares, and those things are very irregular. And capital budgeting decisions. Should we invest in this new piece of equipment? Should we invest in this new plant, etc.? So those kind of things are done once a year or on an as needed basis. And again, the trade-off is between the risk and return. So I've emphasized risk a fair amount already. It is a very important aspect. The two most important aspects of finance are cash and the timing of the cash flows, and obviously the directionality of the cash flows, if it's cash inflow or outflow, and what risk is associated with those cash flows. A brief review of the forms of organization from your B-Law class. You know that a sole proprietorship is one person. It has unlimited liability for the owner. Partnerships are two or more. It also has unlimited liability for at least one of the owners. And a corporate or corporation structure has the least amount of personal liability, that you just can only lose the amount of money that you've invested. And of course, as we're well aware, corporations tend to be the dominant force as far as sheer size, such as WestJet and large pen growth as far as corporations go. But there is still, as far as the sheer number, there are more sole proprietorships and partnerships than there are corporations. But the size of the corporations tends to be larger. You can see some of the advantages and disadvantages of each. This is just a refresher for you. It's not something you're going to be really tested on in this course. So it's just a, nice way to start into the course with some material that you're familiar with. We will be, in this course, focusing on corporations. We will not deal with sole proprietorships, but a lot of the same principles will apply. But sole proprietorships do not have shares. They have more difficulty raising money. They're more reliant on the individual. A lot of similarities between partnerships and sole proprietorships, except there's more than one person. We can actually make it even more difficult. I know of a situation currently where there's two owners of a company and they are not getting along. And by the way, company, I mean partnership, not corporation. And they are not getting along at all. They are disagreeing, they're fighting, and they're trying to dissolve it. And one partner's trying to buy out the other, and it's just a very messy situation. And it's very difficult to untangle yourself from this type of thing. But you at least have more advantages because you have more capital, you have more talent, things along that line. Corporations, as you're well aware of, have limited liability, especially for the people who own it. So if you buy a share in a company for $50, that company goes out of business, you've lost your $50. That's it. They can't come and take your car or your house or your bank account, things along that line. They're more complex. There's more regulations. They have to file tax returns that are different and more complex, etc. And they also have to deal with shareholders, which can be very demanding and very difficult at times. Public markets are where the government borrows funds for the public. The stock market or corporate market are where corporations raise funds, so they issue shares, new shares in the stock market, or sometimes referred to as the equity market. And so they issue new shares, they get the cash, they invest it in a new product or buy new equipment, etc. Money markets. Money markets are very important. They're for short-term financing. You can see it's like the accounting version of current assets or current liabilities. And they are treasury bills, commercial papers, bankers' acceptances, things along that line. Depends on the length of time for promissory notes, but it's basically short-term money, current funds. Capital markets, you can see you don't buy and sell common shares from a corporate point of view. Remember, we are the corporation, not the shareholder. They don't issue shares in May and then buy some back in July. No, that's not the way it works for either common shares or preferred. Bonds, corporate bonds, is large dollars. So when corporations like TELUS want to have a satellite so you can have your fancy iPhones or Samsungs, and they need hundreds of millions of dollars, they will issue bonds. And then, of course, there is government bonds, where does the government get their money? They need to borrow it from people who have the funds. And they do that through government bonds. Where they get short-term money, where they, by the way, is the government, and this is provincial and federal governments, if they need money for 30, 60, 90 days, anything up to a year, they use treasury bills. For long-term financing, they go with bonds, government bonds. Primary market is simply where brand new shares are issued or bonds. And secondary market is what you think of when you think of the stock market. The Toronto Stock Exchange, the New York Stock Exchange are all secondary markets. So most of the trading that goes on is between two individuals. Only when the shares or the bonds are first issued does it affect the corporation. And a lot of you from your accounting realize that. If a company issues bonds or shares, there's a journal entry for that. But once the journal entry has been created and the funds have been received, once the shares are bought and sold on the secondary market, there are no journal entries. Although the company is still very interested in the share price because they want to maximize shareholder wealth. Risk return trade-off. You can see increased profitability may result in increased risk. It'd be really nice if we can increase profitability and decrease risk. And if you want to decrease profitability, you may want to decrease risk. So each one of you in this class have a risk profile. Some of you are very conservative, and some of you are much more of a risk taker. And each one is fine, but the calculation we'll do in chapter 13 has to do with being able to calculate, is it worth the increase in risk to get the extra profits? That's based on your risk profile and your risk aversion, or some people are actually risk seekers. Just to summarize chapter number 1, agency theory is the conflict or potential conflict between shareholders and management, with management wanting to do what is right for the manager as opposed to what is in the best interest of the shareholders. They're not always congruent, are not always certainly the same. Financial managers make investment and financing decisions, obviously. And we talked about working capital, short-term money. They're involved in how much money should be invested in equipment, even inventory. You think about the retail sector is very, very much based on or use of funds is how much inventory they have. And then how do we get our funds? Where do we get it? Do we get it as a issuing shares? Do we issue a bond? Do we get a loan from the bank? And these are just a lot of the same decisions that you make. Do you borrow the funds to go to school? Do you raise the funds by going to work? That would be, by the way, profits for a corporation. And you can't sell shares in yourself, but corporations do, which gives them another source of financing. And that's the end of chapter 1. Thank you.